Good morning, everyone. Welcome to the new week, the new working week, so to speak. So it's Tuesday, September the 2nd, 2025. Recording this in the morning, as always. Okay, have a look and see what's going on. Obviously, this is the beginning of sort of la rentrée. Everyone comes back from holidays. And so we can expect, greater liquidity to come into the market. And it's going to be interesting to see, how everyone deals with where we are in the markets. And immediately this week, we have a lot of data. So that's starting today with the ISM manufacturing numbers coming in at 10 o'clock. They're expected to still be in contraction territory for the headline numbers. So under 50 for the headline, a little bit higher than last time, expected 49 up from 48, but still, as I say, in contractionary territory. Prices paid still very sticky at 65 as expected. New orders component's going to be interesting to see, what the forward-looking sort of situation is according to the purchasing managers. And then, of course, the employment number, which is expected to be a little bit higher than last time at 45, but still very weak. And keep in mind that this is a big focus for the week and with the Fed in terms of, is the labor market weakening or not? That's the big question. And in terms of labor market data, we have a lot going on. Tomorrow, we have the JOLTS number. Again, that's expected to show a little bit of weakness, but we'll get to that tomorrow. So we have all the JOLTS number, job openings and layoffs. Factory orders, we have durable goods coming in. Then also we have the ADP number, which is the private payroll number, coming in on the 4th. So that's on Thursday. We have unit labor costs, which is an important sort of cost input gauge. Then we have, of course, the initial jobless claims and continuing claims. We have the ISM services. And then finally, the big one, just to round out the week, expecting 75,000 for the non-farm payroll. So a lot of data. We have, as I say, the PMIs as well as labor data. So one could argue that by the end of this week, the market will have a much better sense of where the labor market is and potentially also a little bit more of an understanding of where the economy may be going. Now, in terms of the Fed, obviously, just in terms of political thing, let's keep an eye. I believe there's a bit more information happening on the Lisa Cook situation. There's some kind of a court update. We'll have a look at that later in the week. But just in terms of where the Fed is, nothing much has changed over the last few days. We're still expecting over 2 cuts by the end of this year, so 2.1 cuts, which equates to about basically 55 basis points. So that's relatively stable. And in terms of the upcoming meeting in September, the 17th of September, which is now only basically about 2.5 weeks away, the market's pricing in a 90% cut. So the market absolutely is thinking that a cut will happen. So we've got 22.6 basis points out of a possible 25 basis points cut. So really at this point, you'd have to say what would change that. I mean, if we get very, very cold data, so we get, very, very, low 40, mid to low 40s, maybe in the two ISM sort of surveys, we get a bad JOLTS number, a bad ADP, we get a very, very cold non-farm payroll number. Could this start going up towards 50 basis points? It would have to be very, very cold, but that's something which is a possibility. So that's definitely that. Now, what would potentially cause this not to be priced in? For this to go down to, let's say, 12 and a half basis points, I suppose just the opposite. But it would have to be. I think it's a little bit asymmetric in the sense that I think a cold number would pump that up towards 50 is a possibility, a very cold number for the data. But in order for the September cut to be taken out, we'd either have to get some rhetoric from the Fed themselves, or we would have to get extraordinarily hot data, inflation ripping and employment, 250, 300,000 or something like that, which we're not there yet, and I don't think we're going to get. So that looks as though it's sort of a done deal. So plenty of data this week. Just going to grab some tea. Excuse me, slightly scratchy throat this morning. Okay, so that's that. Let's keep an eye on all of that. Just in terms of other stuff, what's going on in Washington, political thing. We saw that the Court of Appeals the other day rejected Trump's whole tariffs and said that they were illegal, and essentially it was the wrong sort of statute was invoked to enforce those, and that really this should be more in the hands of Congress. So on the face of it, that's a pretty important thing. Will this go up to the Supreme Court? It's highly probable at this point, and that opens a whole can of worms. Will the U.S. Treasury therefore have to give back some of that tariff money? The tariff money money's not going to be collected. That would therefore imply sort of higher bond issuance, which could put pressure on the longer end of the yield curve. Although we had Besant, of course, coming in and saying there are a lot of other different statutes which could be invoked to use the tariffs to justify the tariffs. So I think it's going to be a political battle. I think in some shape or form the tariffs will probably stay. But certainly it's something to be looking out for, and that's going to grind its way through the courts, I suppose, over the next few weeks, if not months. But that's providing a little bit more uncertainty. Okay, so let's just look at some other things and see a little bit what's going on in some of the main markets. So we see, first of all, I just want to bring up here, I've just got the UK 30-year bond yield, and you can see now it's up to about 5.68%. So this is the highest it's been going back about 12 or 14 years or so. And it's just been relentlessly going up. And even those of you who remember the Liz Truss moment, which was, a couple of years ago now, and that seemed, sort of pretty sort of outrageous, where she tried to bring in a tax cuts, taxation cuts, which weren't really justified by cuts in spending or anything. And you can see here how the yield spiked on the 30-year then up to over 5%. But look where we are now, and actually higher at that. And that looks as though it might want to push up towards 6% or so. And so the problem here is that, does the UK government, they have a real fiscal problem? Do they have to start taxing a little bit more? Is that going to be, it's going to be difficult now for them to cut spending, because they have cut spending quite a lot. But it does seem as though there is a budget shortfall, and that could mean extra bond issuance. I just saw a headline, I think on the Bloomberg, on the terminal there, saying that the 10-year gilts, let's just check it if my memory is correct. I think I saw it there just a couple of minutes ago. They wanted to sort of push out, where did I see that? Yeah, UK set to raise record £14 billion from sale of 10-year gilts. So definitely what's happening in the UK, there seems to be a budget shortfall. Politically, it's very difficult for them to cut spending. So it looks as though maybe they're going to be raising taxes or issuing more bonds. And of course, the problem if you keep on issuing bonds is that that's going to start steepening the curve and putting the yields, the nominal yields, higher and higher. And of course, at that point, you start getting into the problem of causing maybe lower growth, and that then starts to weigh down on the pound. So if we have a look now at the pound sterling, I mean, the US dollar is relatively strong against everything today. But just if we look at the pound sterling, you see, big juicy red candle going down there. So definitely concerns for the fiscal situation in the UK, the budget situation, and the possibility that they're just starting to lose, sort of control and fiscal discipline, and that could start sort of steepening the curve, but not in a good way, not in a sort of strong growth way, which would be positive for the pound, but more in a sort of an emerging market, government overspending, issuing bonds, having to raise taxation, crushing growth a little bit. So all of this is not great for the pound, and that's definitely something to watch and under pressure. And just while we're looking at some of these currencies here, we also see the US dollar up, again, quite strongly against a lot of currencies, also up against the yen here. And this is interesting because overnight we had the deputy governor of the BOJ, certain Mr. Himino, who said, this is a quote, that despite 3 hikes, inflation has stayed strong. So inflation has stayed strong despite the fact that, the BOJ has hiked a little bit, and that the real interest rates are still quite low. So we say that the nominal yields have gone up, but because inflation has gone up, the real interest rates are quite low. So on the face of that, looked like a bit of a hawkish comment, essentially sort of opening the way possibly for more cuts, to say that, inflation hadn't really gone down despite the cuts. So the implication there would be more cuts. But having said that, just in terms of the currency, the fact that the real yields or the real rates are still quite low is maybe not great for the for the Japanese yen. And the second thing, which maybe is hitting the yen a little bit today, is that we saw that a couple of senior members of the ruling LDP, so the Liberal Democrat Party, they've tendered their resignation, and so we could get the situation. You may remember that like a month ago we had the elections in Japan, and it was a pretty bad result for the sort of the establishment, the Liberal Democrats, and so it looks as though maybe there's the beginnings of some sort of uncertainty in the political sphere, and again maybe that's putting a little bit of downward pressure on the yen. So that's an interesting one here, but I think structurally the dollar and the yen, if you look at the chart here, it does look as though there's some sort of head and shoulders kind of situation for those of you who like classical, sort of chart patterns. But it does look as though this is turning into sort of head and shoulders. And at the end of the day, if we zoom out a little bit, it's just in a sideways consolidation. And if the US government continues to spend itself, is losing its fiscal discipline, there's less sort of independence potentially over the medium to long term at the Federal Reserve. It could also be that this is beneficial for the US to have a weaker dollar, and we could get a weaker dollar, and eventually we could see that the USD JPY tops out, maybe around 150 or so, around about the zone up here, and then eventually that could start to force its way downwards, all the way back down potentially to 142 level, then down to 140, maybe over the next few months. So definitely something interesting to be looking out for there. In the eurozone here, you also see the euro down a little bit today, again on strong strong US dollar. What we did get overnight, we did get the eurozone inflation, which was a little bit mixed. We had overall number was 2.1, which was up from 2%, so a little higher than expected. On the other hand, services, which is still quite elevated at 3.1%, that actually had come down from 3.2. So the services element came down a little bit, and the supercore had come down a little bit. So you could argue that even though the headline number for eurozone inflation was, excuse me, a little higher than expected, it's still relatively stable. And if we actually look at pricing here for the European Central Bank, for the Eurozone, really they're not expected to cut that much more. And if we actually just go out here, let's put it on to the Eurozone here. You can see that their meeting coming up in September on the 11th of September, so only about 9 days away. You can see that, zero potential of a cut priced in. So they're down at 1.92 for their effective, their funds rate, so to speak, their overnight rate. So keep in mind that the European Union, the ECB, has cut a lot more than in the US, for example. And so at this point, the market is not pricing in another cut, not even for, all of the next sort of 8-9 months or so. So we get here all the way out to July 2026. You can see it's only at a 60% chance, or 15 basis points. So that could be a little on the conservative side, a little bit hawkish. Although the European members of the governing council have been out sort of speaking over the last week or so, it does seem the hawks are still quite strong, saying, hey, inflation is stable. It's there's no risk of disinflation. We've conquered inflation. This is a good moment just to do nothing at all. There are some more dovish members of the ECB talking about the potential for disinflation, and therefore, at some point it may be appropriate, especially if the economy starts to weaken, to cut interest rates again. So I do expect that there will be another cut of 25 basis points before, this is not marked here. It's not priced in. So that's an interesting one to look out for. At some point, I expect that to happen, but it looks as though that won't be happening in the next week or so. In terms of other news, let's just look at some charts here and just see where we're at. Equities still doing very well, still up at highs. Let's just bring it up. We see, first of all, let's look at the volatility. So the volatility has gone up just a little bit. We do have quite a lot of volatility, potentially volatile events this week with the data, with the ISMs and all the labor market and the non-farm payrolls and whatnot. But it's still at 17.9, so under 18. But definitely that has, ticked up a little bit compared to where it was for the last couple of weeks or so. So that's something which could start to be giving just a small tail headwind rather for the equities. We see here that the ES on the S&P 500 futures here, you see they're starting to roll over a little bit. But again, if we look at it from a technical perspective, and I'll just throw on, as I like to do, some moving averages here, so some exponential moving averages. You can see we're just sort of touching the 20-day moving average, still a long way down towards the 50. And to be honest, there's no real technical damage done. Oh, you could argue until we get down to 62.50, all the way down here, down to just below the 50-day moving average. So at this point, not a huge amount to worry about from a technical perspective. But as we say, the VIX is going up a little bit, so volatility is going up a little bit, and there could be some concerns here that tariffs taking effect. Is that going to be inflationary a little bit? Fed, are they cutting? Are they not cutting? It looks as though they are cutting. But we'll see what happens here. If we just look at the NASDAQ, you can see the NASDAQ here actually is a little bit weaker, almost down towards the 50-day moving average. And then if you look at the Russell, you can see that that is, actually not doing too badly. Maybe the possibility of rate cuts is more beneficial for the small caps. So let's have a look and see the price action today. It's going to be quite important, I think, coming back from the holiday period and sort of the longer sort of summer period in general, just to see whether this is just, a little bit of trading, a consolidation along the highs, or the beginning of some concerns about the economy slowing down and potentially the labor market slowing down. I don't think we're there yet, but let's keep an eye on it. And just to sort of get a bit of perspective on that, you see the Mag 7 still doing pretty well. Nvidia's of the world still doing relatively well. But again, today's price action will be quite important. And you see also on the equal caps doing quite well. So nothing to panic about yet. Let's see how we go. Other things to be looking at here, want to be looking at the bonds. Interesting to keep an eye here on the French bonds. As you can see here, pretty weak price action. They continue to trade very heavy, and that's because we have the confidence vote in France on, I believe it's next Monday, for Bayrou's Prime Minister Bayrou's government, which will quite possibly fall. That could provoke new elections. There's a lot of sort of talk about the fiscal unsustainability of the situation in France, also Italy, but Italy seems to have a more political sort of situation at the moment. But that looks as though it's definitely has a little bit more to go. Although we are coming up to a little bit of resistance around the 120.50 sort of level here on the bonds. And if you just actually look here at the spread, you can see here that the spread against Germany of the French bonds is starting to rise again. So it had a spike, it came off a little bit, now was pushing to retest those highs again. So that looks like that's going to be a market which is going to be under pressure, probably until we get some kind of political resolution or détente, maybe in another week or two. So let's keep an eye on that. In terms of the US bonds, let's just look at the 10-year. You can see here that that's come off a little bit. This is the December contract. We've rolled more or less into December. So this is the December contract here. You see this is a little bit weak, a bit of a sort of a risk on tone here. We have a stronger US dollar. Equities, as I say, weakening a little bit, but essentially still trading along the highs. And generally, a fairly sort of positive sort of start to the new season, so to speak. What I do want to look at as well is oil. Oil's up a little bit. Again, I don't want to overread into this. We're coming up against all these moving averages. Here's the 20, 50, and 100. There is going to be some congestion here and potentially some resistance around about this level, around about 66. Why is that? I was looking, I can't see any particularly fundamentally wonderful reason that suddenly the global economy is booming and, the surplus is going away. It does look as though this could be just a little bit of a technical breakout, possibly the fact that there doesn't look as though there's any quick resolution in store for us between Russia and the Ukraine, and also the fact that the Israelis continue to pound sort of Gaza, and it looks as though maybe they want some kind of semi-permanent control over Gaza. So still quite a lot of tension in the Middle East. So it's possible that geopolitics is causing a bit of a bid here, just breaking out on oil. Although I can't see myself any fundamental reason for this to sort of explode too much higher, unless, of course, we get some kind of deterioration in the political situation in Ukraine or the Mid East. I think this could find some resistance at the 200-day EMA here, about 67.50. Let's keep an eye on that. I just finally want to look at some of the precious metals we see. Excuse me, gold breaking out. Let's just bring up gold. I'll bring out the Z contract, so December, and you can see here this was in a pretty much a sideways consolidation, never really retraced that much and sold off. And as you can see here, the 20-day moving average always remained above the 50-day moving average. So this was really just a bit of a summertime lull here. And as you can see here, pushing out above this sort of sideways sort of consolidation here, this sort of triangle consolidation, and just sort of stopping, breathing, taking a pause at the highs here. And again, gold, despite the slightly stronger US dollar in the last 48 hours or so, if we have a Fed which is less independent, a Fed which is cutting potentially interest rates into a sticky inflation situation, into a situation where the economy is still relatively strong, this is a good situation here for gold, as we have sort of a debasement of fiat currencies, especially the US dollar. We have sticky and persistent inflation. We have the geopolitical risk. We saw the BRICS meeting, recently with, India literally all holding hands, the Indian, Chinese, and Russian leaders. trying to present, some kind of united front against the US, by the way, which a US Secretary Treasury said called a performative kind of sort of situation, not really to worry about. We shall see over the medium term. But gold, there's a lot of sort of reasons here, both geopolitical, sort of sticky inflation, especially if the front end of the curve comes down in the yield, not so much the back end, but if the front end of the curve comes down, then the opportunity cost of holding gold also comes down, and also the funding costs of holding gold comes down. So there are some quite interesting technical reasons for making the holding of gold more attractive. And allied to that, you also have silver here ripping a lot higher. You see silver here breaking out of its ranges well above all the moving averages, of course. And we'd have to put this, let's say, on a weekly chart and just see just how powerful this is. This is a really big breakout here, and you'd have to start going all the way back to 2011, and you'd have to say that really the target at this point is 44 bucks. In theory, if we can get up there. I mean, it'll probably take a bit of a pause before it gets up there. But silver sort of, there's that $44 level. But silver also benefiting from, a bit of a safe haven, sort of a precious metal. But keep in mind that silver has about 55% of its usage is for real industrial, sort of real world usages. And therefore, the fact that, the global economy is okay and there's a lot of uses in this for, electrification and whatnot, that's probably helping silver a little bit. So interesting to see if this goes a bit more parabolic or just has a bit of a pullback, but certainly the structural elements for the precious metals are in place. And just finally, I want to look at copper. I'm not going to look at the US contract because that's still a bit weird with the whole sort of COMEX sanctions, non-sanctions thing. So let's look at the price in London, and you can see on the London price not really benefiting from the other sort of the precious metals breaking out and just sort of trading sideways in a range. So that's giving you maybe more of a sense of what the markets are thinking about global industrial activity just in the very short term. Okay, guys, I'm going to leave it there. As I say, let's keep our eyes out for at 10 o'clock. We've got the ISM manufacturing. That's going to be the first of the sort of the surveys today. So it's not really hard data, it's the survey data, but for sure that's going to kick off the week. And let's look at the price action in equities as well and see how the big boys on their return from holidays are looking at these markets. Thanks very much. We'll keep this going tomorrow. Have a great day. Thank you.